Welcome to After Hours at Traders Post. I'm Tom Hartman, marketing manager here at Traders Post, joined by Mike, the best of us, Christensen, co-founder and CSO of Traders Post. Today, we'll be talking about the surge in US dollar, taking a peek at the possible recession in China, reviewing IBKR CEO's recent market warnings, and marveling at Google Quantum's AI latest move. As always, we'll be looking for trading opportunities in both the macro and micro landscapes. Whether the age ahead is dark or golden, there are trades everywhere. How's it going, Mike?
Doing well. I'm interested in definitely the trades out of the quantum side. As you know, my bet on Nvidia has played out pretty well. I'm still pretty convinced that they're one of the main benefactors. But when we get into the quantum side, I'm interested in what could come out of that.
What I like here is that the book The Fourth Turning came out, what is it, like in 1997, and talked about the idea that all kinds of changes might happen economically on the macro scale and socially, and that it would open up. It took the world by storm, especially the Wall Street folks and the high street folks, because there are trades that can happen in volatility events. So all kinds of things that can occur. So the high ages, the gold, the dot-com bubble, the global financial crisis, the and the rise of populism that we have right now. And so what I love about markets is that before I felt like I was completely hopeless. There was never any point in reading the news. The more I knew about anything, the worse everything was. And now I feel like, hey, there's an opportunity for me to do something good for me and my family. So
Yeah, I'm glad you bring that up. I feel like early on, especially when I was much younger, my parents looked at the stock market like this. It was too risky of a thing to really get involved in. And then the further down I got down the path of trading and investing and understanding markets, I'm realizing it's really risk and volatility that we're most interested in. That's where the opportunities end up showing up. So yeah, I'm always interested in movement, and it's kind of boring right now too.
well, see, that's what I wanted to talk about first here, the boringness of it, because you brought this up a couple of times, where it's when volatility is low that you have to watch out. When the sky is, seems to be falling and people are running around with their hair on fire, and every other story on CNBC is about how the market's going to crash. That's usually the time where, okay, everything's perfectly fine. Or put it another way, if Jim Cramer is telling me I should be worried, I'm not worried. But when volatility is low, but then there's certain signs that are showing up that shows, hey, there might be some sort of problem coming down the pike. That's where I worry, and that's where I feel like I am right now. So that's why I want to talk about the first story, which, I mean, it's going to be like we've been talking about again and again for weeks, which is this rise in the US dollar. So the dollar has just been was soaring, and now, like, it's basically at a higher high, and we are in the situation where I'm I would have hoped to see the dollar retrace from the DXY pretty sharply. Let me just pull up my chart here.
And it almost did that.
It almost did, and then it decided it decided not to. On the, what is it, CPI went up a little bit, and then central banks all around the world started cutting like crazy. Some of them doing double cuts, some of them hinting at double cuts. And so we have here the chart of the DXY. We have this channel I've been talking about, where we basically been moving up and to the right since the global financial crisis in 2008, 2009, and we get these plateaus, right? We get these plateaus, it moves up, a new plateau, and it moves up, and then a new plateau. What I didn't really realize, and I should spend more time, Mike, I think, looking at the dollar. I don't know why I don't,
You're
but
you're more of an observer than I am. I mean, we brought the dollar up quite a bit on our show here, but yeah, I think one even more a more recent break here was this break at the on the 22nd of November when the dollar pushed above 107.50. We've been stuck in this little range here between 100 and 107 since all the way back since January 2023. So what I find pretty compelling here is this new break, and then of course the potential impact against the other competing currencies that make up the Dixie. Of course, China being one of the components there.
yeah. So we have this thing here where, and this break happened exactly in the pattern that I don't want to see for the dollar. And that's, well, I mean, you don't want to see if you want things to go well. Dollar going up is not usually a good sign. And so it broke above the weekly average, came retest, and seems to be holding. So if we actually get a high a new high above 108, 108.18, let's call it, then we are in another move up to the top of the channel, um, and that's not good because we have all this support down here that we just haven't been able to crush. I mean, we really bounced off really hard off of that. And one thing I noticed recently was that this period of time is about 700 days. It's almost like
Even in that last range there,
sorry.
even in that last range there.
Yeah, it's about 700 to 800 days, and
Yeah,
it's usually
700 days.
about yeah, it has to do with like uh, funding cycles that happen throughout the world, and these things sort of like coincide with options expiries. Another thing we talk a lot about. So I believe over here, this peak over here happened in March. March OPEX is one of the major OPEX, and then we had another peak. This peak over here happened in September. September and March are the two OPEX periods that are the most significant because the two other ones, one happens in summer where things are quiet, and the other one happens in December where things are quiet. So often September and March, and around those periods of time is when you get big crashes or big liquidity squeezes, and so we're quietly heading towards the next one in February, March of this year, which is, to me, I'm hearing the fuse on the bomb ticking that when we get there, we're going to get another huge rise up to the at least at the top of this range, which coincides with what we're seeing here in the bond market, um, where you'll let me know if it's a little bit too crazy here, but there's two things I want to point out here, Mike. First, this if we take a look here, this jagged line here is the federal funds rate, and it's right now above the long term rates, and it's coming down. Well, when that happens, the other times that has happened is over here in the global financial crisis 2007 and the dot-com bubble in 2001. So it's not usually a good sign when the Fed funds rate is above long-term rates and all of them are falling together, and then one falls faster than the other. And at the exact same time, volatility is low. So down here we have the VIX, which is low. VIX is down to 13, which is still relatively low. We have the move index in purple here that's fallen down to 82. We have the NSCI, the financial credit that's falling. So it's like it's the calm before the storm. It's it's the sort of thing that really really worries me, because it's when things like this break, we don't exactly know where it's gonna pop up, right? So we don't know if it's going to be in emerging markets. We don't know if it's going to be within domestically, within the housing market, within tech stocks, within Bitcoin. We don't know, and I'm not seeing the signs yet that's telling me where things are going to break. But it definitely looks to be within the signs are certainly starting to bubble within the markets. Have you been seeing anything that's like worrying you? I know there's no real shortage of sign like doomsdayers if you want to look for doomsday stuff, but has anything popped up on your charts at all that makes you wonder, like, hey, this is suspiciously volatile or suspiciously quiet?
I mean, like I said, right now things are suspiciously kind of quiet, with overall ATR down on SPY as well as the VIX being pretty low at the moment. The range is getting tighter and tighter. Price action is a little bit tighter. Even futures markets are pretty quiet on a day to day basis. We've got some nice moves on NQ, but the ES futures are tradable. Their ranges are fairly tight. It's fairly predictable right now. So usually in those calm moments, that's when I'm always trying to prepare for big spikes in volatility. I think another consideration that I'm making right now across markets is just keeping an eye on price to earnings ratios. And one of the metrics that I try to keep an eye on is the Shiller PE. We had this big uptick in October of 21 to a PE of 38. And if we go back to the charts of October 21, excuse me, just pulling back that chart, once we had reached that point of the average PE being somewhere around 38, 39, there was one more blow off at that point in December of 21. And then that was a big pullback for us, all through all through the next year into December of 22. So I am keeping an eye on the Shiller PE. When we had that pullback in markets through 21 through 22, the PE went all the way back down to about 28. And we've since then risen back to 38.55 as of today.
Hmm.
So that Shiller PE ratio just tells me that in general, equities are a little bit overpriced. We'd like to see them closer to a valuation of around 15 on average. That's been sort of the historical ratio. If we look at the average PE over the entire history of the S&P 500, it's about 17. So right now to see it at 38.55, it's a fairly high number. It's one to keep an eye on. And if we're in these low ranges of volatility, I'd be expecting breakouts here that cause excitement. One other, thing that I always observe, especially in trading accounts, just watching traders trade in general, and having been around trading for a long time, when volatility starts to contract like this, people usually start to pull their stops a little bit tighter, and they start getting used to this new tighter average true range of price. And I just think that sets off stops faster. And then you end up seeing this big feedback loop. So where normally you would have maybe put your stop a little bit further out because you needed to account for volatility, if everybody's trading inside these tight ranges, you start seeing stop losses get triggered pretty quickly. As
That's very interesting. So that whole sort of thing, like where people want to get into the trade, but then they don't want to give back too much to the market, so they trail their stop.
Yeah, a little bit, or at least the stops in general are just much closer to your to entry prices. So on if there's any kind of volatility event that spikes here, just a lot of stop losses get hit right away, and that triggers a little extra volatility in markets.
Actually, I haven't asked you when you're setting up or when you've seen people set up automated trading strategies. I'm always curious if they change their input settings based on macro events that are happening. Like if it's around certain periods of time of the year, or if certain events are happening with governments or fiscal spending or anything like that. Do do you have to adjust an automated strategy to then account for that? I know there's some adjustment like over volatility events, FOMC meetings, CPI reports, whatever. But if the macro environment seems to be one way, if the economy seems to be one way, would you change your settings in a automated strategy?
I mean, I do personally. I have a volatility adjusted stop on a lot of my strategies. If there's any kind of trailing stop, the starting point isn't just a fixed number; it's adjusted relative to volatility. And if I'm not adjusting my stops, if it's already a fairly wide stop that's accounted for historical price action, then I'm just adjusting my position size accordingly. So that way, the risk is relatively flat over the long run, right? If volatility starts to increase, position size comes down, the risk reward proposition is roughly the same.
So I haven't been having this issue where I'm down the VWAP rabbit hole that you sent me down some months ago. I feel like I'm never going to get out of that. And so in consolidation ranges, I can. I wonder if I should pull it up. In consolidation ranges, I use the daily VWAP in order to just scalp trades. 1%, 2% throughout the consolidation range. Because I'm in crypto and I'm using 50x leverage. Well, it's pretty good. Can be pretty good returns if that's there. And then I have this other strategy where I'm trying to capture these trends when the breakouts happen. And I'm finding that sometimes I need to be aiming for the daily VWAP, and sometimes I need to be aiming for the weekly VWAP. And in major events, I need to be aiming for the 1 month VWAP. In
Mm.
order to make sure I don't get shaken out of trades. Because let's say there could be a bullish trend, and I'm still in a bullish trend, but there might be one or two candles that really wick down all the way down to the weekly VWAP or some 3 month VWAP, and I would get stopped out of the position. But if I were just to leave it, well, it would rebound and it would get back in. And I'm curious if you have any advice how I could deal with this, because my instinct is to be like, well, I should just remove my stops and just allow the account to get liquidated, and just, I don't want anything to get me out of the trade. But then at one out of every four times, it does actually liquidate the entire account because it moves so drastically, and I get out of the position. Do you have any advice for something like that?
I think you're kind of describing the second part of the adjustments that I make with strategies in general, which is more of a position sizing adjustment based on volatility, so that you don't end up getting stopped out. so early or getting liquidated so early. You know,
Right.
if you're well away from your margin requirements, you got a lot more opportunity to let the trade move.
Hmm. Well, I'm trying to work out something because I really want all of them to work. I find that if I'm paying attention to the trade, like I can tell if this is if I should, human beings, we could read more into the chart than what our algorithms could figure out. And I could be like, okay, no, I should really get out of the chart. I'm being greedy right now. Or other times I'd be like, no, 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 let me add more margin to it because this should go. But the letting it on its own, I find myself lying awake at night going, should I have closed that position or should I add more margin to it? Oh, it's such a
What
terrible feeling.
what I find interesting lately, and this is definitely a tangent, is the screen share functionality that you can now use in ChatGPT. I would be wondering how ChatGPT might be an interesting guide to your approach here to think through what it sees on the screen with you. I'm surprised that you haven't been using this more for that exact function to give it a sense of what you're trying to trade and watch the chart change and get a sense of what ChatGPT might be saying in response.
Well, because I find I can always make an indicator that tells me the opposite of what I want to hear. Like I always go, okay, I have 10 indicators here, and 9 of them say go ahead, and then I'll make another one that seems to correlate very nicely with the moves, and then it'll say no, you should do the opposite of what those 9 do, and I just. The more I look for information, the worse it seems to go, which is why the VWAP to me has been so unbelievable because I could almost get rid of almost everything else. If I just had the VWAP to trade, like if I had one indicator I had to use, I would just use VWAP. That and looking at the dollar tells me essentially where the trend is going in any liquidity asset, especially like Bitcoin. So
Sure.
yeah,
I guess to that point though, it's pretty difficult not to get chopped out sometimes, especially when you're trading long ranges. But
that's it.
it's an inevitability at some point.
Excellent. Well, along the same lines, we're talking about macro liquidity, which is the thing I care so much about. Our next 2 stories is exactly about this. The next one is about the PBOC. So the People's Bank of China, China in general, they are they are adding liquidity times 2. They're increasing spending. They're increasing support for the country on a fiscal level. And I just wanted to play a quick clip from Bloomberg of analysts talking about it, and we'll come back on the other side.
And as we go into that in the next few days, or well, yeah, on the back of all the developments over in South Korea. We'll leave it there for now, but certainly it's still going to be an eventful weekend as we go into that in the next few days or so. Back to China, though. Let's bring in our Chief North Asia correspondent, Stephen Engel, here in Hong Kong for us to wrap what we've heard so far out of Beijing.
Yeah, I mean, a lot of talk, not a lot of specifics. I mean, Annabelle went through that fiscal deficit target upwards of maybe 4.5. They just said they're going to raise that. I think they're comfortable usually with about 3%. So it does indicate, and they have indicated, that they're going to boost public spending and borrowing as well. But the big emphasis this year, the top priority coming out of the Central Economic Work Conference, is to boost overall domestic demand, so boost consumption. And how are they going to do that? And the devil will be in the details, which we probably won't get, in great detail until the National People's Congress in March, since this is essentially what they did behind closed doors the last couple of days, is set the agenda and set the priorities for that NPC in March, the Lianghui, the 2 sessions. So what do they do? Well, they did talk about some of the drags on consumption, and that is household spending has been pretty weak, largely, too, because of the rising healthcare costs, rising insecurity, lack of confidence. So people have been squirreling away a lot of their money for their own health safety net, their social safety net. And that's something that the work conference talked about. They're going to boost pension support and healthcare and trying to get the households to feel confident and also spend more. So that's going to be the big driver this year. But not a lot of welfareism coming from Xi Jinping.
All right. So when it comes to China speak, it's sort of like Fed speak. You got to be careful. It's never going to be, especially when there's representatives speaking on behalf of the Chinese government. It's never like, oh my God, everything is terrible. Everything out of China, everything's great. We're just making small tweaks in order to make things better. However, China is a centrally run country, and they try to make moves that literally move the entire country one way. Like if they want everyone to go into real estate, they are going to make make rules and regulations to make everyone go to real estate. If they want you to buy stocks, they can make you buy stocks and all that sort of thing. So a couple of weeks ago, we talked about they did this massive stimulus in order to get people the stock market back up, and we got this boost in a bunch of Chinese stocks. I don't know if you remember, there was like this run up of like 100% off the lows for a bunch of these stocks. They've all turned over. Alibaba, MSCI, China, a bunch of these assets all turned over, and so now they're like, oh yeah, well things are fine, but we're just going to do another massive stimulus, just to get things back on track. And what we hear here from this analyst, and he says the keywords, they're trying to get the feeling of the population into such a place where they will then spend more, because they need the Chinese population to spend. And what they're doing is that they're saving, they're scoring away, which is all recessionary signals, right? That's contraction within an economy. There's government fiscal and monetary spending. The population is not being convinced. They have to do more and more and more and try to get the population to do it. They're not doing it. That means it's recession and bad recession. Why does that matter? China is the production engine of the world, right? So is Germany, but Germany doesn't pump a bunch of money into the system if things go badly. China does. So there's two things here that if you're looking for the trade here, the trade is when China pumps money into the system, Bitcoin goes up. Bitcoin goes up and the dollar goes up because they're devaluing the currency, so the dollar goes up, and then the increased liquidity shows up first, and the asset that seems to be the most liquid of all liquid is Bitcoin. So I think this might be part of the reason why we're seeing, almost certainly this is part of the reason why we've seen such a run up in Bitcoin to 100,000. And when the last stimulus came out, and now with this stimulus over the next 70 days, which is usually how long it takes for the China stimulus to go through the markets, I wouldn't be surprised, just like we saw Bitcoin go from 60,000 to 100,000, for it to go up another 40K. I see that totally in the books.
I can see that path. On a Forex play, I would be interested in seeing what happens as the Chinese yuan against the US dollar breaks below potentially 13 cents for the first time in quite some time. The one factor I would consider here is that these Chinese stimulus packages are really designed to try to offset the impact of a potential 20% US tariff. There's some research out of Goldman Sachs right now that just came out, and they're trying to anticipate the impact that's going to have on GDP growth into 2025. So I would anticipate that any effect on the currency play would be somewhat short until we can see the effects of GDP by quarter 2, quarter 3 next year. It's going to take some time. And in general, tariffs are going to be fast in terms of their plan, but not necessarily in their execution. I don't expect the actual stimulus plan will get executed very quickly. It was a similar outcome in 2018, 2019 during the trade war between the United States and China. During that period, it was a slow moving process, but there were some trade opportunities that took place on the Chinese yuan during that small window. So this is an area I would be keeping an eye on as well.
So for the, I haven't actually asked you, can I ask you, are you long Bitcoin now? Are you bullish Bitcoin?
I do hold some Bitcoin.
No, like in the trade, let's say for the next 3 to 6 months, are you like, oh yeah, I'm looking for Bitcoin to get to 200K?
Yeah, it's still trending. I'm not at a point now where I think Bitcoin is a sell, or even one I would start to scale out of. There's no question we're in a rally still.
Well, because I wanted to make it clear, I said that VWAP was my number one indicator.
Mm-hmm.
Mike's my number one indicator, and VWAP I use as a confirmation signal. Because I go, okay, because you don't give yourself into the hype, whereas I'm looking at Solana charts and SUI charts and all these different tickers, and I go, should I buy any of these things? And I also like, okay, if Mike hasn't mentioned it, I'm not really gonna jump into them.
I'm still, I'll hold a basket of cryptos over long periods of time, but long run, I'm actually increasingly becoming more interested in maybe just adding to my Bitcoin holdings and just seeing it as another form of a store of value, which is really what I think it is. We've seen a lot of comments from people, even from
Powell.
Powell, yes, of course. We know that the Trump administration is very pro cryptocurrency, which is fantastic for the bull run we're in right now. But I think even the story here we have on IBKR CEO coming up is worth addressing here. I think that there's this sense that because you can't value cryptocurrencies, that makes them inherently worthless. And I'm going to push back on that idea. You can't inherently value gold, yet we still see it as a store of value. And so the argument for holding it long term and it being a potential form of currency in the future, and I'm thinking like 30, 40 years down the line, I see Bitcoin as being kind of the winner there. But anyway, that's neither here nor there. So I have two competing problems here. On one hand, I'm trading Bitcoin. On the other hand, I'm trying to hold a little bit of it as well. So there's a long-term play and a short-term play there for me.
It's interesting because I've mentioned multiple times here that as a Canadian, all I want is US dollars. And I will sell my Canadian dollars in a second for anything that's not a Canadian dollar. And for US, I just go, well, why would I? To me, having US dollars is like having gold in my safe. Like, why would I sell my US dollars unless I have to? It's just going up in value versus my currency. It makes no sense. But for Bitcoin, I'll sell out of Bitcoin if I think RSI is too high. But I'll never do that with USD. So I should have maybe a different thought process.
I'll
I
just
just
hold a
can't.
little bit. I'm adding a little bit, and I'm gonna save it in a hardware wallet. It's gonna be one of those. Okay, I'm just not touching this because
So how do you feel then with some people who, like, let's call, the crypto folks who they've denominated everything in their life in Bitcoin, and like they're doing well?
I'm going to go back to, I mean, this was my original theory in 2012 when I first read about Bitcoin. I'm like, great, I'm gonna buy as many of these as I possibly can. And I took Bitcoin to the first $1,200 run when no one really anticipated that it would go from $36 or $37 to $1,200 the first bull run that it really had. When it reached that point, I pulled all my chips because I had no idea what the future of Bitcoin was, and I certainly was no Bitcoin maxi yet. So the trade made more sense to me to get back into US dollar denomination. And then maybe I was ready to buy more later. And I ended up taking another swing and bull run in 2017. And I traded that all the way to Christmas. And it ended up selling right around, I think when I started seeing it pull back just a little below 20, I saw how much panic there was in the market. So I joined the panic as well and pulled my position. And I've since dabbled in cryptocurrency in a lot of different ways since then. But I keep thinking about this idea of going back to 2012, I think at one point I had 400, 500 Bitcoin. I mean, it would have been an absolute fortune today. And one of the early platforms where you could make purchases was Overstock. And so I bought items from Overstock using Bitcoin because I was like, well, what's the purpose of this thing? You're supposed to buy things with it, right? I still have items from Overstock that now are the most expensive things I've ever purchased. And so you have to ask yourself, like, if you are a Bitcoin maxi, you have to decide at what point you're ready to actually use it as currency. And I don't think we're anywhere near there yet. We have to let this long run 20, 30 year period of stabilization in price to occur before I'd feel, comfortable starting to actually spend it. Otherwise you're overspending for goods, if that makes sense.
That's right. That's what, to me, the trade, if you will, for someone who is aspirational for crypto, but someone like me who I'm not a really like big believer in Bitcoin itself. I think that the crypto space makes sense. The use case makes sense, and I want to see more things come out from that process. But to me, betting on it feels like betting on AOL. Like, I don't care how big you're telling me that it is, not you, but the royal you. There's something about a thing that can track every one of my transactions and that anybody can see everything that I've ever done. That to me just goes, well, I don't ever see me ever using that as a currency. Someone shows me how they could add a privacy layer on top of that, I'm all interested. And until then, I don't believe it. But increasing my skill set so that I can actually serve the crypto space or things within the crypto space, I think that to me is like unbelievable. That to me is like if when I heard about Twitch You know, when I was 19, 18, I could have been playing video games and making and learning how to, you know, do YouTube videos. And back then, I don't know if you remember, but people would be like, what are you doing? You're ridiculous. You're playing video games that will never lead you anywhere. And now there's 14-year-olds making $100,000 a year. So playing video games, like, so to me, that's like the crypto space. I'm looking for projects within there that I find to be interesting, dealing with the people in that space. And then I'm sure things will hit, and then you know, I won't be a newbie in that sector. And the same way that SEO for Google, you know, it took off, and you can make $250,000 a year like that if you knew SEO back in the day where it was about putting white text on white background on the footer of your page. I mean, that's the level of money you could have made for the least amount of effort. So that's that's like the trade I'm looking for. We'll see.
Fair enough. Well, back to, I guess, back to China here. I think the, and one correction from earlier, I mentioned that the Chinese yuan was a component of the DXY, and that's not correct. It's the Japanese yen and a few other currencies. But that said, I still think that the Chinese yuan as a trade, potentially, I'd be looking for a breakdown below that 13.61 line right now as a short.
Well, just to add to that, the even though it's not a directly component, it does affect the yen because of the competition in that area.
Sure.
And so there's an indirect effect on the value of the dollar. All right. So I wanted to touch on, you brought him up. Let's go ahead and talk about billionaire CEO of IBKR Interactive Brokers, Thomas Peterffy, who had two things to say this recently. The first one is here, we can see on the screen. So over the last 3 months, our margin loans are up 16%, and which is rather, it's a bit, if you ask me, because I think that equity prices are somewhat overextended, and I hope that as they come down, they will not come down too fast, so we can liquidate as it happens. We will not end up with holding the bag. So basically, people are so levered up with the markets. He's sort of like advising other institutions to be like, hey, we maybe be careful with how we're extending margin, because people are like over levered, and if there's a market correction event, it could be pretty significant. I just want to play here a small clip from him on Bloomberg that talks a little bit more about what I want to hit on.
Let's do it. And I want to call this potential risk out on the crypto market as well. I think the amount of futures trading and levered trading that exists in crypto now presents a similar risk if we start seeing a pullback in crypto.
Agreed. All right, so let's take a look here.
No audio.
Oh, and I hear an audio. Let me redo it. All right, let me know if you can hear it here.
And if you have one area that investors should look at for next year, the biggest risk on the horizon, everyone is talking about so much growth and soaring stock markets. You mentioned you're worried that you could actually see a downturn, which is contrary to what everybody else is out there saying, right? Many people are out there saying right now. What's the biggest risk on the horizon?
So a downturn is a very big risk because margin balances have been growing very, very quickly. And especially if you take a thing like Bitcoin, I mean, you know, if, margins on Bitcoin futures, for example, charged by the CME are extremely low. So I am very worried that people overextend themselves. A sudden hit comes into the market and Bitcoin falls, say, 30, 40, 50% from one day to the next. There'll be many bankruptcies. The clearinghouse will be unable to pick up the pieces, and it basically will, the bad debt will be transferred to the clearing members. So this is a difficult situation. if it happens. Now, the probability is not very high that it will happen, but it certainly could happen. So I wish that everybody please pay attention to these situations and try to take preventive measures and do not extend margins so easily.
So, look, we don't hear from this guy a lot, right? He's not one of those people who is going around trying to drum up traffic, let's say, for interactive brokers. That's not been the his MO. You'll correct me if I'm wrong, but I don't. I've been looking for him and I don't see him like everywhere. He pops up every once in a while. And
yeah, he's not like he has a huge following on Twitter or anything. This isn't a random or a daily news kind of guy. I'm with you on that.
That's right. And that post that was up there, where he was talking about the margin issues, he took down that post afterwards.
I was wondering why I couldn't find it before the show.
Yeah.
Yeah.
It disappeared. And so that to me is sus, right? Someone says something like that initially, you're like, okay, maybe they're looking for clout. They take it down afterwards. It means they said some truth that they're looking to hide. I mean,
where was that post originally, by the way?
It was a quote from, it wasn't on Twitter. It was, I forget exactly where it was. I think it was a Discord channel that someone was referring to that, but then that person took down that post afterwards.
So we don't know if it was actually him that typed that.
Well, it's someone transcribed what he said.
Oh, I see. In what was the source of his statement? Oh, okay.
Well, that's why I went to go get this other video of him on Bloomberg, he is saying something similar.
Yeah, that makes sense. So yeah, I mean, just from the warning that he's issuing here is a margin warning, which interestingly enough, I mean, this story is as old as markets. Even the smartest people on the planet get trapped by margin from time to time. They get slapped in the face by getting overextended in their positions. I remember I follow Ernie Chan, who's a great quant in the space. He runs a fund as well as a platform called Predict AI. Great guy, super smart. And he has a strategy called the Tail Reaper, which at the time that they began running it in 2011 or 2012, I can't remember the exact year, they saw it was so successful that they ended up going 7x leverage, 8x leverage, something like that. They just kept levering it up because it was working so well. And then for the first time in U.S. history, the U.S. bonds had been downgraded from AAA to AA rating. And that absolutely crushed them. I think they had something like a 35 or 36% drawdown in a very, very short period of time, which took out most of the performance. And if you're looking at 35 or 36% drawdown on a leveraged account, that's a pretty large sum. So I think the warning is worth addressing. Everybody feels like they're brilliant in a bull market, and that's exactly the time to be prepared for that downside risk, because when it happens, especially when margin use is higher and higher, I just think that breakout volatility event is pretty extreme when it does occur.
So this is a shortcoming I think I have within my arsenal, where I don't have any strategies set up that are only waiting to trigger based on massive volatility moves within the markets. And I think I should be setting stuff like that up, because it's one thing to be like, okay, we're looking for it to happen, but there is no better buying opportunity than at the lows of COVID, at the lows of Brexit, at the lows of GFC. And these are life-changing trades. So I'm always like looking for the drop, because that's historically where I've made money, like waiting for the drop on the other side.
Mhm.
But to have something that could pick up, limit orders, just waiting at certain levels, like rock bottom, where it's only there, those candles, it's only there for an hour. And you go, you bottom tick that? Like, yeah, I bottom tick COVID. Like, that would be unbelievable to write that trade. And then you don't need any leverage, you don't need any risk, you don't need any options or anything like that. You can just ride this thing back up 100% as they try to buoy the market. So I think I got to set up some strategies like that, both in crypto and in TradFi, in order to get that going.
Yeah, and I think that the signal is a bit counterintuitive. It's not a spike in volatility that's your signal. It's all-time highs and really low volatility. That should be your initial signal to wonder if you should start de-risking, or at least be paying attention to what's happening in the market. Is there still room for upside? Or are we in extreme greed? One of the indicators I like to use is the one from my friend Jason Meshnick, who came up with the Fear and Greed Index on, I think it's still on CNN's website. And right now that indicator is at neutral, which, normally in a very extreme condition where we're really seeing prices move higher and higher, that extreme greed signal would be an area where I'd be paying attention. So it's nice to actually see it at neutral as of today, because that kind of gives me some comfort that we could still see some potential upside through the next couple months.
I see. So you found this to be accurate? This is the first time I've ever actually seen it.
I got to be honest, I've never actually tested this against the historical performance or forward-looking performance of the S&P 500, but I can say that it's accurate in its current measurements.
Understood. Well, the other thing that the CEO was saying was that, and I believe he was saying this, that 70% of the volume through interactive brokers is happening on the Mag 7.
That sounds right.
Which is,
I mean, we see that even here at Traders Post. We're aware of what symbols come through our platform, and for the most part, it's exactly what you think it is. Whatever symbol you think is popular right now, that's the one getting traded.
Okay, so we don't have, I guess, as much history in Traders Post to know if this is a worrisome outlier. If everyone's on the one side of the boat, I'd expect a more even distribution across, not even, but more of a bell curve distribution, because to me it seems like 70% on, and he was saying this as a warning, like this is not what we don't usually see this, and oh, by the way, you other clearinghouses, you're not charging enough margin. Like, this is gonna be a problem. We're not gonna be able to handle it. He says if there's a liquidation event of 30 to 40%, we're screwed.
Yeah, I think the fair call out here is that when those warnings start happening, there could still be months of continued upside before those warnings actually start to make sense.
That's what drives me crazy.
I'm with you. That's timing markets is incredibly difficult. So while his warning makes sense, the Shiller PE is concerning. Potential overbought conditions are concerning. We may still see a market move that heads up another 10-15% from here for equities, and potentially another 20 or 30% on crypto.
So that's where Kim Carson, to me, is my hero, because he not only provides context for all that, but he goes, if it's going to happen, it's probably going to happen around these periods of the year. And so it's like, I'm worried about March.
Yeah,
September.
Seasonality, I think, can play a role. So it's definitely another one of those, like, okay, where am I at in the calendar? Where are we at in seasonality? That's always helpful. Maybe that's a follow-up we should do on our next after hours, is just trying to bring in some of the seasonality of historical trends.
Good idea. Okay. So I want to end off here on something that, frankly, I've been worried about, and I try not to be worried about because there's plenty of other things to be worried about, and that is quantum computing. So Google had an event a couple of days ago where they released Willow, their new quantum computer chip, which is, I don't know if I'm as deep inside of it as you are, but wow.
I wouldn't even consider myself an expert, but my understanding of the problem that they had it solve is a benchmark test that is incredibly difficult for even the most advanced classical supercomputers to solve. And I think the analogy they gave was the quantum computer Willow was capable of solving this benchmark test in 5 minutes, when it takes our fastest computers about 10 septillion years to solve. And I was trying to think of different analogies to compare the differences between those two, because our minds simply can't grasp how big that number really is. I mean, this is logarithmic math here, right? And the best analogy I could come up with is, Tom, you sitting there right now, your heart beats once, just one time. It would be like the difference of one of your heartbeats versus every heartbeat of every lifetime of every human that has ever existed through all time, and every human that will ever exist in the future. That's the difference. One heartbeat versus 10 septillion heartbeats.
Oh my God.
And it is incredibly faster. So obviously the exciting thing about this is that these these quantum processors are basically able to do a lot more in parallel. Things can be processed a lot faster than the way CPUs or even GPUs process information. And as we know, AI is one of those industries that's dramatically impacted by compute time and compute speed. So I'm very, very interested in the commercialization of something like this for the AI space. I think obviously Google ends up being a clear winner in all of this. I would also be interested in knowing how they're going to use this technology to boost the performance of Gemini in the long run. What I can say, though, is that I don't think we're anywhere near to this being a commercial application. Like, it's fair to point out that Google's done this before, where they've made these huge accomplishments in technology. And the perfect example is Waymo. When they started this project for DARPA back in 2009, it took them, the next 15 years to get a commercial application in place where this would show up on the streets. And now we have, more rides being conducted in San Francisco by Waymo than ever before. I think it's going to be years before we see a potential application, because there's just so much to iron out to get it to improve stability. But this is a very interesting turning point, and it's definitely one to pay attention to. So I'm going to be keeping a close eye on Google and their roadmap for this technology.
So I just want to play a quick 2-minute clip from Harmit Nevin, the Google VP of Engineering, who's talking about this to a newscaster. And the reason I want to play this is that I tried to find clip after clip after clip of Google actually talking about this, and it might as well be Mandarin as far as I'm concerned. Like, they're just like, even as a coder, I'm like, okay, but what does this actually mean? So let me just hear what he has to say here, and then we'll come back on the other side.
Yeah, the biggest news for today is that we developed a new, very high quality quantum chip. And this enabled 2 breakthrough computations. And one is an error correction, where we showed for the first time that as we use more qubits, the error rate comes down, and it comes down exponentially. The second important achievement, breakthrough achievement, is that we did a benchmark computation, took just 5 minutes on our new chip, that would take the top supercomputer 10 septillion years to perform. So 10 septillion, audience may not know, that's a 1 with 25 zeros. So it's a mind-bogglingly long time.
And it took 5 minutes. What I want to understand is what this benchmark test is, benchmark random circuit sampling. What does this prove?
Yeah, so this benchmark problem, we often say, is not a problem that people on Main Street have yet. But it's a suitable benchmark to compare different quantum processors to each other, or to compare quantum processors, quantum chips, against classical computers.
What's so mind-boggling about quantum more generally is that we have been talking about it for decades, but it always feels another 5, another 10 years off. Is it different this time, Hartmut?
Yeah, quantum computing is definitely not that field. There is steady progress, and our new chip that we just released, Willow, will form the basis to start doing useful computations that will enable or solve problems that humankind has.
Let's talk about those problems then. Everyone immediately goes to healthcare, drug discovery. Is that the most obvious place with which this sort of computing is going to be helpful?
Yeah, so the well-understood killer application of quantum computers is to model systems where quantum effects are important. And that is more often the case than you may think. For example, if you want to understand how drugs, pharmaceuticals, bind to cells, or if you want to design a nuclear fusion reactor, or something as mundane as improving the batteries for an electric car, all these engineering challenges involve quantum problems. And their quantum processors are just the tool of choice to solve those problems.
All right. So two things I loved
Can I
about that.
just say, yeah, I'm sure
Yeah.
you're going to speak to his fashion choices here. And if
It's from
not,
Future.
then that should be your first call out, because I want to know who his designer is. I want the sunglasses and I want the NASA blanket shirt. That is awesome.
Well, what I loved about this was that first on the newscaster side, she's again and again in different ways. She's like, okay, so how does this matter? How does this affect our lives? And she kept trying to find ways of saying it, and he kept trying to say, and to him the simplest way of saying it was that any anywhere where superposition helps with computation will be benefited by this. And he's trying to say to him that's the simplest I could possibly say. Like major engineering or brain chemistry. He's like, things like this that require. And she's like, I
Yeah,
have no
stuff that's
idea.
important to our daily lives here.
Exactly.
So I think that only proves my point that they're going to continue to use this in research realms. I'm not sure this goes to a commercial application very quickly.
Well, what matters the most to me, it was two things. One, I very much suspect, and I started reading on it today, but I'm going to read more about it. That the large language models have helped for these chips to be developed, and because Stephen Wolfram from Wolfram Alpha, he talks about the idea that he's been working on basically a computational language learning model, and he didn't realize that language models can actually help. That if you pair computation with natural language processing, then you get a type of computation that's way stronger than either. Right? So LLMs have difficulty, and we all know this using ChatGPT and Claude or what have you. They used to have like great difficulty just doing 2 plus 2. um, but computational models can. But then computational models have very difficulty understanding what you're saying in natural language in order to output it. Well, there's whole industry now, this backend industry, where they're merging those two things. And so you do that with the type of research they need in order to develop these chips. Well, you have way more iterations that are happening way faster, and I would not be surprised if it's not that just this chip is going to help Google Gemini, but that Gemini helped make this chip. And so I think we're going to see this quadrillion dollar industry happening in the back end. Now, the other thing I thought was interesting, it's sort of tangential, but the thing that's also on my mind with quantum computing was that I also thought that quantum computing will break crypto, because crypto is based on cryptography. And I was like, okay, well, if you have this thing that could crack anything, then it should crack it, and it'll make Bitcoin and everything useless. But
Yeah, that assumes. I think maybe. Sorry for interrupting, but I assume that you're seeing this as an opportunity to improve cryptography, right?
So there's been that discussion, but like you just said, these things are not commercially available. So it's like, can you imagine if it's in the hands of a few and they're able to crack it, but we don't get to see it on our end?
Yeah.
But Google specifically came out to put out articles that are saying, hey, this type of thing, even though it can do 10 septillion, uh, you know, better than classical chips, it can't crack cryptography. They said this. They said this is not one of those things, because I think there are even regulations in the United States that specifically say that if a technology can crack cryptography, then it falls under, like, I think, national security type things, which makes sense. And so they come out specifically to say that. So then I'm just like, okay, like, so what is this? It could do brain surgery, but then it can crack crypto. Like, what is going on here? What is actually true? And so to me, what I want to be looking for, and this is another reason I like markets, is that I like seeing moves in markets that are not explained by obvious macro or micro events. And if I see something like that happen, where Google, let's say the Google stock goes up, Microsoft stock goes up drastically, while some cryptocurrency coins drop, that might be a signal to me that, oh, there's some sort of crack within the crypto space, and maybe I should leave. So it's like a small thing. It's sort of like when I see bonds yields go up and the dollar go up, I go, okay, trouble coming. So if I see AI assets go up and crypto go down, okay, quantum computer problems. And it could also make it that invested in Google, in a sense, maybe could be a hedge against crypto falling. If you needed something to be like, well, how do I benefit if crypto falls because of this quantum thing? Well, invest in the quantum computer company.
I think it's a bit of a leap. Like the way to think about the Willow chip is more like ASICs, right? They're application-specific integrated circuits. They are more capable of solving specific problems, not general purpose distributed workloads like hashing involved in brute force password cracking. So the start of this will be to solve these types of research problems that I think is it Hartmut? Is that his name? That's what I thought I saw earlier.
Yeah,
Hartmut. Those are the types of applications he's referring to, and that's mainly because this isn't really a general purpose card. It can't solve all kinds of different problems the way a CPU or a GPU can, but obviously they can build it to head in that direction. It's just going to take time. I think that the question around whether it gets into the wrong hands, probably not. It's not really the same thing as like our current LLMs, right? Where this is really software based that requires hardware in order to function. There was an explosion of competition in the LLM space where people were providing new models that, you know, were almost on par with what OpenAI had developed. Obviously, Facebook's Llama was an example of that. I don't see anybody building any quantum computers in their basements, though, to compete head on with what Google has, and potentially having the ability to crack passwords or crack cryptocurrency cryptography well in advance of something like this being commercialized.
Fair enough. Yeah. So my worries of like there are teenagers with genome resequencing machines that used to cost $100 million that only cost $10,000 inside the garage. You're saying I don't have to worry about that for the quantum computers for a while.
I don't think so. I don't think so.
Excellent. All right, so I'll leave it there. But before we go, I know there's some questions in the chat. Is there anything we need to be answering here? They'd love to. I know someone was asking specifically.
We had some early on questions around whether we had courses on PineScript. No course at the moment. That could be one we consider in the future as part of maybe our ongoing Thursday blueprint session. There was a question around. I think that was it. That was the one we had called out. Peter had already responded to one of following up in our PineScript channel on some scripts around VWAP. And obviously we've got a lot of opinions on VWAP, as both you and I are big fans. So happy to discuss it within our channels there. And obviously, if you're interested in more of the PineScript type of content, we do that every Thursday at what is it, Tom? 3 p.m. Eastern?
3 p.m. Yeah,
3 p.m. Eastern every Thursday, with holidays obviously excluded from that. But we do try to cover all kinds of different scripts there. We cover different ways to use PineScript to automate trading strategies. Obviously, Traders Post is in the business of helping you automate all of your strategies across stocks, options, futures, and crypto. We love talking about markets, but we love automated trading even more.
And I've been trying the TrendSpider AI strategy builder.
Okay.
I don't know if you got your hands on it.
Not yet, no. So you'll have to show me how this is working. I'm very interested in exploring that. We're going to do that in an upcoming episode.
Yeah, I think we should try it probably Thursday. I'd love to give it a shot.
Okay.
I'm trying to get like results that make me really excited. But again, showing really good results on stream makes me hurt. So I don't know if I want to do that.
We'll try to be a little more prepared.
All right. So we'll be back on Tuesday for office hours to answer questions about using Traders Post. We'll be back on Thursday, like Mike said, for Blueprint. I'll be back next Friday for another after hours. But for now, we'll wish you a great weekend and thank you so much.
Cheers, everyone. Happy Friday.